Thanks PMS Bazaar for giving us this platform, this opportunity. Thank you everyone for joining us on a Saturday morning. So aim is to give you a update on how we are seeing markets, but the topic is very interesting. The three E's which are very important for equity markets to do well. The first one is economy. The second one is earning, and the third one, which is very important as per my belief, is emotions. How we can manage emotions obviously play a very important role, that how much we can make from the economy, from the earning, from the equity markets over a longer period of time. So aim is to give you update on these three E's at this point in time, how they are positioned as per our belief. Moving on. So normally whenever we talk about equity, we talk about what is going to happen in next 5 years, next 10 years, next 15 years. But it is very interesting to understand that how economy has progressed in last 20-year period. And interestingly, if you see this data, India actually was not there in top 10 economy till 2009. We became 9th largest economy in 2010. We became 7th largest economy in 2015. 6th largest economy in 2020, and today we are 5th largest economy. So in last 10-year, 15-year period, from being nowhere in top 10, we became 5th largest economy. And clearly by various different agencies, it is projected that India can become 3rd largest economy in times to come. So while this is the journey which is relative to other countries, how we have progressed in last 20 years, but this is again very interesting. I'm sure we would have seen this data many a times, but at the cost of reiteration, it took almost 60 years after independence to touch that $1 trillion GDP mark. We became $1 trillion GDP size country in 2008. We became $2 trillion GDP size country in 2015. We became $3 trillion GDP size country in 2022. We could have achieved that mark a year earlier if COVID was not there. But nevertheless, today we are around $3.7, $3.8 trillion GDP size country. So clearly we have grown in a very rapid way in last few years compared to other economies. And clearly from here on, the first aim is to touch 5 trillion, and obviously then we'll keep on growing and achieving various different milestones. The one part which brings a very strong resilience in our economy is consumption, and Anirudh actually gave a lot of data points on this. Clearly, if you divide India's population basis income group, and if you see 20 years back, it used to be more like a pyramid shape, where the lowest income group used to be dominant in the economy. But in last 20-year period, the shape has changed. It has become more like a pyramid shape, where the middle income group has become more dominant. And in any economy, when we see that middle income group is becoming more and more dominant, you see discretionary consumption picking up, premiumization as a trend picks up. If I show you one sector, very interesting sector, auto, how the sales number were 10 years back and how the sales numbers are today. 10 years back, entry-level segment of the car used to be around 43% of the sales number, and 7% used to be SUV. 2023, if you see the number, entry-level segment is less than 25%, while the SUV segment is around 40%, upwards of 40%. So clearly that gives you some insights that how the trends are moving. And in and around also you can observe that how many people are sending their children for foreign education outside India, how many people are traveling abroad many a times in a year today, how many times we are ordering food from outside, right? So there are 21 meals which are cooked in a week's time. How many times we are ordering today from outside, and what was the trend around 10 years back? Clearly, these are the trends which gives you insight that premiumization is picking up, discretionary consumption is picking up, and clearly it will create a lot of opportunities for a lot of companies in that value chain. Moving on, and I think this is the most interesting slide in the presentation, which is trying to highlight last 8-year data. Which is between 2015 till end of 2023. And interestingly, if you divide this 8-year period into two parts, first between 2015 till end of 2019, and second 2019 onwards, interestingly, they are very different compared to each other. If you remember, the period between 2015 till end of 2019 was when economic or macroeconomic situation of country was reasonably well placed. For a very long period of time, crude was between $40 to $70 per barrel. Inflation was in control, interest rates were moderate, but despite all that, earning per share, which is profit growth rate of Sensex, mid cap and small cap, was negligible. For large cap, this number was less than 2%. For mid cap, this number was more than 2%, and for small cap, it was 0%. So there was no profit growth rate at an index level for almost 4.5 year period. And there were reasons for it, and every year reason kept on changing. It started with asset quality review of banking sector. For next 2 years, banking profit was impacted. 16, we saw demonetization. 17, we saw implementation of GST. 18, we saw NBFC crisis. 19, we saw consumption sectors getting impacted because of tight liquidity situation. So these were few reasons because of which, despite having favorable macroeconomic situation, companies were struggling and the profit growth rate was negligible. Interestingly, post 2019, we had whole host of macroeconomic challenges starting COVID. Then you had geopolitical issues, war, higher crude oil prices, higher inflation, higher interest rate. But despite that, if you see last column of the table, which is highlighting the earning per share of market in last 4-year period, the number for Sensex is more than 15%. For mid cap, this number is more than 25%, and for small cap, this number is more than 45%. So earning numbers, which were muted for almost 4.5 year period, has seen significant improvement post 2019. Again, for this also, the data can be looked in two ways. If we see from a layman point of view, and if you analyze any crisis of last 15, 20, 25 years, normally you'll observe that after every crisis, a stronger company becomes more stronger. And a crisis like COVID, where a lot of companies, a lot of sectors were going through tough time, once the situation was normalized, the stronger ones were able to do reasonably well. Another way to look this data is there were a lot of issues between 2015 and 2019, but a lot of positive steps also were taken, like implementation of RERA happened in 2016, which is regulator for real estate. To resolve the NPA issue of banking sector, insolvency bankruptcy code came in 2016. GST was implemented in 2017. Corporate tax cut was announced in 2019. PLI kind of initiatives came post 2020. Last 4-year budget, which was very, very focused on spending, and spending is happening behind infrastructure, railway, metro, where the multiplier effect on the overall economy is very strong. And along with that, few trends which Anirudh also highlighted, China plus one, Europe plus one, playing some bit of role in this earning improvement. Our aim is to identify companies where this earning growth rate number can remain strong in next 3-year, 5-year of time frame, and aim is to identify them at a reasonable risk reward ratio. So that is what we are trying to do. But coming back to this data again, this data, if you see, is of indices: large cap, mid cap, small cap. And to understand from where the delta came in this earning growth rate, what we did, we tried to divide markets into two parts. So if you divide markets basis B2C and non-B2C, and see the period of 2014 to 2019, you'll observe that B2C companies which were more near to the consumer, they were doing reasonably well. Their profits were growing at around 14% CAGR, higher than the nominal GDP growth rate of the country. But the non-B2C part of the market, manufacturing allied is large part of that, was going through tough time, and the EPS growth rate number for that part was around 4% only. Again, for both, there are reasons. Companies which were near to the consumer were doing well, but companies which were competing with countries like China were going through tough time. That's where the change started happening in 2018, 2019, when there was conflict between US and China, and because of which a lot of large corporates and developed world were open to diversify their supply chain. And that's the reason if you see this data after 2019, first of all, nothing has changed from consumption point of view. And that's the reason I said this brings a lot of resilience to the economy. These set of companies, the B2C set of companies, even after 2019 are doing well. They are growing at around 13-14% CAGR on the PAT number. But the non-B2C part of the market, manufacturing allied, which was growing only at around 3-4% in the previous 5-year period, started contributing in a very big way. Post 2019, we have seen the number is upwards of 19%. So clearly, the point is, in the previous 5-year period, only one part of the market was doing well, which was consumption. But post 2019, we have seen both part of the market started contributing. And that's the reason at an aggregate level, the earning numbers have seen significant improvement. So point is, the number of companies which are contributing the PAT growth in last 4-year period, 5-year period has increased. And obviously for investment manager, the opportunities to invest have also increased over a period of time. Now this data is again very interesting. Corporate profit to GDP, which was upward of 5 in 2007, 2008, actually fell almost at 2% level in 2019, 2020, and now again it is improving. It is upward of 4%, 4 and 8% today. And clearly it is very interesting because if your corporate profit is expected to remain strong, the tax collection number can also remain reasonably decent. And if government spends well with that collection, the entire virtuous cycle for the economy can play out in a very big way. You can see how GDP growth had been and how the corporate India growth had been in last few years. While the GDP growth rate number had been around 10-11%, the corporate profit, which was muted in the previous 5-year period, had improved significantly post 2020. Now, even if you take base of 2021, the growth would look reasonably decent. Moving on, The another thing which is driving the multiple re-rating, where the re-rating story is happening, is consolidation in the sectors. And we like those sectors which are consolidating. And even sectors like bank, if you see top 6 banks credit market share used to be around 47-48% in 2017. That number is upward of 60% in FY24. Cement, steel is classic cases where the consolidation is happening. Even telecom is very classic. Obviously, it was a 10-12 player industry, has become 3 player industry. And I would say now that consumption is no more a discretionary consumption. It has become more like a non-discretionary consumption. Even our drivers or maids, if you check, they are consuming somewhere between 12 to 15 GB every month. And if you remember 10 years back, for 1 GB, what we used to pay and what we are paying today for 10 GB is almost equivalent. So moving on, this data is again very interesting. If you see BSE 500 return on equity, which was upward of 20 in 2006, 2007, 2008 period, went below 10 in that period, and again now improving. Why this data is important? Because if your return on equity is less than cost of capital, obviously you'll not try to put a lot of capex. If your return on equity is improving and it is upward of capex, obviously there is a possibility that capex can also pick up. In last 10-year period, a lot of corporates have gone through a deleveraging cycle. You can see how gross debt to equity numbers, net debt to equity numbers have fallen. In last 10-year period, majority of the heavy lifting of spending was done by government. But clearly, because of PLI kind of initiative, because of corporate tax cut, because of China plus one, Europe plus one, we believe the corporate side of the capex will also pick up in a very big way. Obviously, green shoots are visible, but widespread phenomena, if that happens, clearly it will put economy into a very interesting phase in times to come. Moving on, in the same period where India being nowhere became fifth largest economy, in the same period, if you see how the equity markets have done, right? And you can see someone who invested 1 crore in BSE 200, which is in a way reflection of India's performance. 1 crore today is approximately 25 crore, and the CAGR return is 15%. When we see 1 and 25, obviously it gives you very interesting picture of the market. But what we have tried to highlight in the same slide, how many times market had corrected by more than 20%, more than 30%. And you can see there were various instances like dot-com bubble, fall of NDA-1 government, in a very strong bull market of 2003 to 2007, when Fed had increased the rate, market corrected by more than 30%. 2008 global financial crisis, market corrected by more than 30%. You saw demonetization, you saw many other things in between. The point is, all this will lead to volatility. And that's where the third E of investing, which is emotions, comes into picture. What we need today, we need to be more patient. We need patient capital today into equity markets, which can remain in market for 5 years, 6 years, 7-year period. And that's where all this volatility can be actually played in your favor as an investor. So what we believe, there is difference between volatility and risk. Volatility is part and parcel of the market. Specifically, when you are coming into equity oriented product, you have to be open for volatility. Volatility is where the stock price falls, market falls and bounces back. What is risk? Risk is where the stock price falls and never comes back. And we have to minimize that part of it. And we believe to minimize risk, what you have to focus on, you have to focus on 3 things: business, management and valuation. So if you are investing into businesses which are growing faster than the sectors, and sectors which are growing faster than the overall economy, that will ensure that you have a superior growth rate compared to the overall economy. But for any business to grow sustainably for a very long period of time, they have to have some sort of moat, some sort of differentiating factor. And that can ensure that your growth is not only for 1 year, 2 year, but it can sustain for a longer period of time. Once you like the business, the second parameter, which is very, very important, is corporate governance, and which is where the management role is very, very important. And in terms of capital allocation, the role of management is very, very important. So that's the second parameter which we have to be very focused on as an investor. And third is valuation. And valuation is third because ultimate aim should be to invest into growth-oriented companies, because you are into in an economy which is growing at a very rapid pace. But the valuation which you pay, even for a good quality growing company which is managed by a very, very competent management, has to be reasonable. If you pay very high premium, then probably your margin of safety is much lesser, and probably you have to wait for long to make some kind of return out of that investment. That's the reason these 3 parameters are very, very important, and that is what we are trying to focus on. This is again very interesting, and obviously Anirudh also touched upon this point. Should we invest today or should we wait for market fall? And this data is giving you some insight that on 1st April 2021, Nifty was 15,000. At 15,000 level, the P multiple of Nifty was 33. Today, Nifty is at 25,000 level, near to 25,000 level, the P multiple is 23. So actually, because markets are tracked on a daily basis, that number is visible on every second basis, while the earning numbers, which is not reflected on daily basis, that has also improved significantly in last few years. And that's the reason the valuations are not as expensive as they were probably 3 years back. So we are in a phase where markets are neither very expensive nor very cheap. And when you are into that phase, you have to focus more on what you have in your portfolio. And that's where the company specific things are very important. And with that philosophy, we are trying to operate. You can see that the title of the slide, companies create wealth and not markets. So ultimately, when you are coming into PMS or AIF, the 25, 30, 35 names which you have in your portfolio matter more compared to your view on the overall market, overall sector. And that's where this data is very interesting. You can see there were phases in between from 2007 to 2012. From peak of the market corrected by 30-40% and recovered. In that 5-year period, the market return was -5%. But in that difficult phase of the market also, there were almost 70 companies which have delivered more than 15% CAGR return. So the point is, you have to identify companies rather than focusing too much on the entire market, entire economy. That is what we are trying to do internally. And the main two driver which we believe which can lead to the performance of the portfolio, the first one is profit growth rate and second is valuation. If you get profit growth rate right, and if you are not paying very high valuation to buy that set of companies, probably over a 5-year period, 7-year period, the return out of that portfolios can be decent enough. That is what we are trying to focus on. Aim is to identify companies where the profit growth rate is expected to remain strong, where there is a possibility of improving ROE, and aim is to enter or buy those set of names at a reasonable risk reward ratio. So that is what we are aiming for. Moving on, how few of our portfolios are positioned, and whatever I said in terms of philosophy, whether that number whether that philosophy is visible in data or not. The portfolios which we have today, or the companies which we have in those portfolios, if you see their 3-year PAT growth rate number versus the benchmark, the PAT growth rate of a few of our portfolios like Contra, where the number is around 32% compared to index, where the profit growth rate number is 25%. First of all, profit growth rate at an index level of 25% is a great number to have, but the portfolio was able to identify companies where the profit growth rate number was slightly higher than that. The ROE profile of the portfolio has seen improvement, where the number has gone from 12 to 15. And along with that, if you see valuation of that portfolio on price to earning and price to book value multiple compared to index, the valuations are reasonable at this point in time, or near to the benchmark at this point in time. So the point is, you have set of companies where the profit growth rate number is high, your ROE profile is improving, and along with that, the valuations are reasonable given where the markets are today. How the portfolios have performed in last few years, the portfolios have done well. Last 1 year, 2 year, 3 year, 5 year, 7-year period, the portfolios have done well compared to the benchmark. But the point is, this data is of no use for someone who is planning to invest today, because it's already delivered. Someone who is planning to invest today, for them, this data point is more important. That what we are entering into companies where the profit growth rate number is strong, where ROE profile is improving, and along with that, where the valuations are reasonable. So the point is, in India, in next 5-year, 7-year, 10-year period is very well positioned compared to other countries across the globe. The economic expansion looks more stronger today compared to the last 5-year, last 10-year period. We have gone through a lot of changes in the economy in last 5-year, 7-year period in terms of reforms which we have taken as a country. Obviously, all the fruits of that are expected to play out in next 5-year, next 10-year of time frame. Right set of businesses we need to identify, and if we can identify them and enter them at a reasonable valuation and hold for a longer period of time, we believe returns can be made for investors from here on also. So with this, I'll take a pause here. Thanks a lot for patience listening, and hand it back to PMS Bazaar team. Thank you.